Every chart that I show is 15 minutes unless I specify otherwise. Okay, so here's your opportunity for the trades. You had stop hunt low rise, easily identified, Brinks trade in the shadow, 25 to 50 pips, 3 pushes out of the box. 2 pushes, consolidate, 1 more push to pick up the orders. You had a straight rise. If you grab the entry in here, anywhere in here after the hammer's issued in the shadow, you had a straight rise of profit. You were in profit in the first 15 minutes of the trade, depending on where you grabbed it. Maybe in the first 30 minutes of the trade. You then went negative, which used to scare you out of the business. When that went negative on you, 4, 5, 6, 7 pips, what'd you do? You're like, oh, crap. They're going to get me. I'm going the wrong way. Any trade that you ever take with this method remains valid until your perceived low of the day or high of the day is breached. Let me say that again. It's important. Any trade you take with my rules and my method remains in play or valid until the low of the day, where you should be entering long, the high of the day, where you should be entering short, is breached. What do I mean? Okay, let me draw. High of the day is formed right here. You took a short right off it. You got jacked up. You're excited. Okay, no problem. The better trade is just inside the shadow box short. That's all right, though. They hit it again. You're short right here. Your trade is negative. Your stop loss is above the range. You're out of the range. You're out of the grasp of the market maker. Think for a minute. He is not going to move a $4 trillion market to get Robert. Or Ted. I don't know if Ted's in here. He's not going to move the entire market back to get outside the range to pick up your measly 1-lot contract. No offense to your lot size. Understand? If he moves a $4 trillion market back up, he releases $500 million in volume to pick up your order. He has 2 hands. In one hand, he has $500 million grabbed up. Right? He'll look at it, right? He'll move to a level and analyze. He pulls away and he goes into consolidation off the high, right? If there is $700 million up there, he nets $200 million. He'll break the high. He lets go of the 500 and grabs the 7. He's a greedy bastard. If you understand that, he is not going to move the market unless it's financially advantageous for him to get your stop order. Some of you are writing that sometimes you feel like he goes after you deliberately. No. The reason why that you feel like that is because you've read all the same books that all the other guys, 90% of the traders, have read. And you put your stop where 90% of the traders put it. So what's going on here is you get in and you go, oh, my stop's right here. This looks good. It's a good trade today. Market maker comes back, spikes the high, and takes your stop out. And you're like, damn it, I swear to God, he's personal against me. Then it drops like you thought anyway, right? He's going after me personally. No. You've all had the access to the information that everyone else has had. It's all the same general knowledge. It's all bullshit. So when everyone gets stopped out at that price point, it's because the technicals that you saw that he deliberately showed you on the chart validated what you read in the book. So you took that trade based on that garbage, and he laughed to himself as he hit your stops, all 100 million of you. Understand? That's why when you took those trades and they didn't validate and you felt like he was personally attacking your stop loss, he was not. He is not going to move a market to a price point to get Mac or to get Michael. He's not going to do that. But if it's financially advantageous for him, he'll make the second pass or the third pass. This costs money to move the market. I heard that it takes 10,000 lots to move the market. A pip. I didn't hear it. I was taught that. Think about that a minute. If you have to move the market all the way back up here, it costs money. If it costs money, he's not going to do it unless he can make some in the process. All right, I want you to notice some crazy stuff built into this structure or towards the high, okay? I want you to see a 1, 2, 3 back to the high in there. Do you see that? 1, 2, 3 back to the high. Why? To induce you to chase it long. I want you to notice they rise here, and each subsequent pass fails to take out the previous high because there's trap volume here, there's trap volume here, there's trap volume here. There's stop orders all aggregated in here and in here. His job is to hit the stops, don't release the volume, hit the stops, don't release the volume, sorry about your luck, just kidding, and drop price 100 pips off the high to end the day back in consolidation. Boom, right here, end the day back in consolidation. And just if you weren't sure, he has to end the day on a hammer to trap anybody that was chasing it short last minute, snatch that away from them, and end the day trapped, carry you into the next day. Do you see what I'm drawing, what I've been illustrating for you? It's in there. Releasing the volume means that if there's a certain amount of traders that they already trapped, by going back to that level, it allows people to click their mouse and get out. Think about yourself in your own trading. How many times have you been jammed up in something instead if it goes back to +1, I'm getting out. If it goes back to -5, I'm getting out. When you come back near the second pass, you will be minus some number plus the spread. -7, -5, +2, +1. I don't know. It depends on where you got in. So what he's doing, if he goes back and breaks that level, he's allowing those traders that were jammed up a chance to close their account out with a small scratch or a small, loss or gain in the trade. His job is to not allow that behavior, so he fails to take out the high. Okay? All right, I hope you guys are good. Let's see where we're at. Next slide. Okay, it's 8:30. We'll do this slide and we'll break for 30 minutes is a good dinner time. We'll try 30 minutes tonight. If it's too long, we'll shorten. If it's too short, we'll go an extra 5, whatever. I'm going to grab a little something to eat, and I'm going to get some more Diet Coke. If I'm not jacked up enough for you guys, I'm sorry. Some of you made comments. I feel fine, man. So if you think I'm too calm tonight, I'll be more excited tomorrow. Okay, look. Very important to understand. Market makers have limitations. They are limited what they can physically do to the market. If you think about this for a minute, they're controlling the value of imports and exports. You buy Toyotas and you switch your dollars to yens. They're controlling that. They cannot just wake up one day and drop in 1,000,000 pips and devalue the dollar or devalue the yen. They cannot do that. They have restrictions placed on them by the IMF and the World Bank to try to keep this world afloat. That is why the average daily range tool, told you I'd get back to it, Mac, is a useful tool and can only move most pairs about 200 pips a day to 600 pips a week. And if you notice something on some of these charts, they will open the week at a price point, go berserk, and come all the way back and close the week around the same number. They do not, contrary to popular belief, have unlimited equity. They got to get their money back. That's where the retrace against the trend comes in. They lend it out, they lend it out, they lend it out. They got to get it back. They are limited by weekly net change allowances. They have a couple of times during the month where they can run rampant, but they got to get it back under control. Think, use your head. If they could do that, they would destroy the world economy, and things are bad enough without doing this to people. They have some limitations. Understanding the limitations gives you an edge. Understanding that they don't have unlimited movable pips gives you an edge. Okay? All right, let's take, it's 8:31. Let's go to 9 o'clock. And we'll pick it back up from there. Hope you guys are doing okay. We're going to go to about 10:30 tonight, I think. And then we'll be good. All right, let me find my little clock somewhere. I'll pop it up there. Go ahead and grab a break. I ain't going to say anything now that it's break time. I won't do that to anybody. All right, let's see. Clear. 7 minutes ain't going to work. I saw a couple questions. Craig had 2 good questions. Let me cover those real quick because they are time appropriate. They're in the right segment. Steve, you said there's 3 important things: the patterns, the timings, and what? The answer is the levels. Okay, most important element in the system, the pattern, identifying the patterns from the market maker behavior. The timings of those patterns and counting the levels. The levels are not going to come to you overnight. They're difficult. There's people that have been around me for a year still struggling with that. It is not an absolute necessity to be successful with this method. But understanding the levels will let you know when the reversal's coming, when to exit your swing trades, and so forth. Okay, weekly net change allowance was another question that came up. Let's say they open at a price point. They're given, just to make it easy, 1,000 pip movement weekly net change. So from the open price point, in the 3 to 4 day swing range, they cannot exceed 1,000 pips on the close on Friday. So if they rise price 1,000 pips or 1,100 pips, they have to come back below the 1,000 pip marker that's given to them before the close on Friday to keep currencies from being devalued or whatever. There's seasonal targets, quarterly. There's daily and weekly ranges that they're given. Understand they're making money, but at the same time they have to be cognizant or aware of what's going on in the world economy and the world markets. They cannot destroy things. So they're given a price point on Monday or Sunday night at open, and they have a weekly net change of 500. They run at 600-700 pips. You can expect the reversal back in to underneath the 500 limit by Friday close. Hence, false trap move on Friday to end the week. Okay? And then the cycle starts over. All right, those are some good questions. I think some of the other stuff wasn't pertinent to right now. Let me look a minute. Nice to have you, Adam. Glad to hear you're doing so well. Shahid from Toronto, I think you left. You'll be back. All right, Ronald, nice to see all you guys. All right, let's get going again. Everybody settled in from their break? Got something to eat? Okay, listen, the reason for the break is I want you to think. I don't want to just sit here and I want to throw a fire hose at you with tons and tons of information, and you sit here just mesmerized by what the hell did this guy just say. That's not the point. I talked to you about some stuff, some concepts. Think about it on your dinner break. Resonate on it a little bit. Tonight I'm going to give you some homework assignments to think about more stuff. We're going to go about 4 hours of time. 10:30, 10, I don't know. We'll figure it out wherever I am on the slides. The point of that is that I don't want to just sit here and just keep stuffing stuff down your throat. I want you to think about it overnight. And when I've taught live, I noticed that people have about had enough in about 4 hours. I'm not so full of myself that I don't realize you get tired and that I think I just have so much great stuff to say. I understand that. So 4 hours is the marker to where you've had enough of sitting in the chair. Seems to be when I'm teaching live, people start slouching their chairs, putting their heads on their desk. Gloria fell asleep on me one time, 4 hours in. So I realized 4 hours is a good marker. Take a break about halfway through, get up, eat something, go smoke one. Subio, did you quit, by the way? I've been trying to quit Diet Coke. I almost made it, and I fell back into it. I'll get it, man. Anyway, the point is that I want you to get this. Me rushing through it to get all the information to you is not the point. The point is it's a process. It takes some time. I asked if you quit smoking, Subio. I know you were trying. I've been trying to quit Diet Coke. Anyway, that's the point of the break, okay? Appreciate it. I want you guys to really conceptualize and understand this. It's not going to be part of you until you conceptualize it becomes your own. And that's the point of going slow and making sure everybody gets it. Okay? All right. Back to the slides. Market maker moves, all right? We understand all the things we talked about, the pattern, the behaviors, what they do. So what can they do? What can they really do to you? They are limited by weekly net change and allowances. They're also limited to, they can hit your stops up or down. They reverse off of the high or low and create an intraday trend change, which happens a lot. They can do a straightaway, straight rise or drop, which is the finishing move on the margin levels of the other traders. I'll illustrate that for you, don't worry. Timings and test your patience, right? What do I mean by that? You get in something, you lift your stop, you're down a negative float. They go into consolidation, change shifts, the Asian guy comes on, you're still sitting there. What happens after a day, day and a half of doing that? Your nerves are shot. Your patience have been tested to the max. You're drinking Red Bull, kicking the dog, cursing under your breath, and you finally click out of the trade because you can't take it anymore. Understanding that all they have is timings and stop hunts and trap moves kind of removes the curtains from Oz. You understand what's going on. That's all they got. They're limited. The problem is that the other technicals set you up for failure and keep you chasing the wrong things. Like I said earlier, it ends today. Okay, this is one of my favorite charts. This is 2 days back to back. Go look at it. It's in the pound. It's in March 15th. Stop hunt high, spike to the high, drop. W formation to end the day, back in consolidation. The next night, stop hunt low. There's your three pushes, your vector. Right? Come right out, rise price, right back. Here's your weekly net change, Craig. 2 days, no change. The price closed exactly where it opened. It's kind of funny. This is they got to be kidding, right? They come out, hit the stops high, three pushes, drop. W formation back into consolidation. The next night, they exceed the trap level here by making a stop hunt to trigger the traders, induce the pendings, and then snatch the market away and run it back, right back to the same price point they were at yesterday. That's why the pattern is so important. You really can't count the levels in there. It's a little harder. But the patterns and the timings are right there, exactly as I stated for you and illustrated and drew out. I mean, one could argue that this is the U.S. reversal, and this comes in around 9 o'clock in the morning, whatever, and then they go back in the consolidation. But this is the epitome of what I've drawn for you on the charts. It's there. What I want you to do as a trader is stop getting caught up in the moment. Getting caught up in the moment forces you to make irrational decisions. You need to have a plan of attack before you come to trading in line with the market maker's trend. Don't let the aggressive moves fool you. Don't let their big spike candles to the high lure you into thinking it's momentum. There's going to be a midweek reversal which will coincide with the intraday reversal and levels. Okay? What I meant was, okay, let's draw this little pattern over here, okay? Consolidation, Sunday, Monday, right? Sunday, false move. Let's just call it Sunday. They break to the downside. They hit a level. They pull back. This might be Monday. Okay? They have a trap amount of volume there. They go into consolidation. Tuesday, they come back and repeat the level. This is a multi-session W formation. But what happens here is they come back. This might have been Asian session. They come back and repeat the level at the London Open as a stop hunt They disguise the second leg as a stop hunt to make the traders continue short. They take out anybody that went long in here, and then they reverse the market. Then you will have your 3-day unidirectional swing to the end of the week, or going into Thursday, and then they will make the pullback to end the week and end the consolidation off of the high. This number in the 3-day range might exceed the net change allowed for the week, so they have to pull back to end the week below their net change allowance. The threshold might be right here at 500. They exceeded it. They know what they got to do. They got their marching orders. They got to come back below and close. Okay? Once you can identify consistently, and by the way, the 1-hour chart helps with this, the midweek reversals and the multi-session M's and W's, you can convert your spot trades to swing. You know you have 2.5 to 3 days of upcycle or down cycle with the maximum potential move of 200 to 600 pips. If you catch the trade going into Friday, understand that you're going to get a reversal pattern coming out of one of the opens, London or New York. You're going to get a stop hunt. If the stop hunt is counter to your directional bias, you take. All right, let me explain that again. If you get into day 3 and you're a buyer at the beginning of the cycle, when you get to day 3, if London open, they come out and hit the stops high, you take. You get out because the reversal is coming. You react to their action. Market makers hit the stops low, you buy against the retail trading herd. Market makers hit the stops high, you sell against the retail trading herd. The M&W, the multi-session M&W will be very, very aggressive. Think about what they're doing. They're taking profit, cleaning the board, and putting money in their pocket. In order to do that, those levels have to be very aggressive. Okay, now let's look at some typical week stuff. Now that you understand a little bit more about the pattern. Okay? Aggressive move, week beginning. Trap the traders, jam them up. Stop hunt low, rise. Back into consolidation. Stop hunt low. Rise 100 pips. An extended high of the week formation. Extended. Why? The blue box is 103 pips. This is about a 150 pip move. What happened? You didn't believe me I wanted long? I'll show you long. But if you notice where they cut the level, this is in fact peak formation high for the week. If you have a peak formation high for the week, we expect 3 days of drop. Okay? So what's expected? I'm going to give you some more slides on this, but think for a minute. Day 1, peak formation high, high of the week, got it. The next night, hit the stops high, drop, or straight drop. The next night, hit the stops high, drop, or straight drop. 3 days. End of the cycle, look for the W reverse. That's the 3-day swing trade cycle. Peak formation high, high or low of the week is identified. You expect 2 more stop hunts in line with the peak formation. If he throws at you something different, exit the trade and look for a new signal. Okay? So here, peak formation high of the week, right? You got the midweek false move. They jam people up long. People think this is the famous continuation. When the high holds, notice the blue tracer in here. I'll talk about that. Very important. When the high holds for 30 to 90 minutes and they pull back, you have your peak formation. The projection is MAW. A1, A2. peak formation, V-top turned over, V-top, reversal. Okay? 3 levels are seen. 1, consolidation. 2, consolidation. And 3 was underway. Okay? The 2 cycles, and I have slides for this, I'll talk about it again, is WVVM. It looks like a W. 1, 2, 3, reverse. 1, 2, 3, reverse. That's the market maker cycle right there. Okay? MAAW, WVVM. Why the V's? Sometimes you'll get W's every single time. But here's the thing. If you have your market maker bias high of the week, low of the week established, and you know the direction, you can trade off of the first stop hunt out of the box V bottoms. You don't have to wait for the second leg because you know the cycle. The best trades are multi-session M's and W's, multi-session or intra-session M's and W's. Those are the best patterns, beyond the shadow of a doubt. It allows you to grab close to the low of the day. Your stops will be tighter. It avoids you sitting through the repeat the level stress of them coming back. But if you understand the cycle and caught the directional bias, then this spot trade can be converted to a swing. Why? I caught the peak formation high. The next night, hit the stops high, I'm still good. If they break out of the top of the box, I'm still good in here. Why am I still good? Because they hit the stops high, issued railroad tracks at the London Open in line with the peak that lets me know it's a false move drop. Now, they've created some amount of margin trouble. They've created a ton of congestion, right? Chest colds in there. Hitting the stops in both directions, picking up the contracts. No congestion. Take some NyQuil or some Tylenol PM or something. You understand that you got one more day of drop on the cycle. Your bias is to the downside. So you're looking for excuses or reasons, stop hunt high drop. Okay? I don't want you to counter trend trade at A1 and V1. I don't want you to trade back towards the peak formation high because it's a sucker's trade. I have slides, don't worry. I'm just illustrating it now. We'll get to it. Okay, here it is again. Consolidation. Peak formation. I expect, hit the stops high. Same slide, sorry. Now the reversal comes in. End of the week, I expect this. I had 3 levels of drop. The pins on the candles will become the direction that they're trying to trap. Very important, write that down. The pins on the candle at level 3 will become or start to paint in the direction that they are trying to now trap. Level 3 aggressive moves will be seen. Notice how the first 2 days of the cycle it drops down smooth, and then when you get to level 3 it doesn't seem to go anywhere. Why? You're reeling it in, reeling it in, reeling it in, grabbing up the traders. Okay? Again, hit the low, spike it. See how this went slightly past it? They spiked it with a hammer right outside the box. The spike of the low absorbs the pending and triggers the stops of anybody that got it right. They open the spread at the low of the day. You'll see them work this. The spread gives them an edge against the retail traders. It's their weapon. If you're a buyer, they open the sell side, drop the sell side below the price point. The sell side picks up those orders for short holders. But the buy traders are held. The level is held. It doesn't move. It sits there. And the same is done in the opposite direction. At the top of the price range, the sell orders are held. and the spread is opened up to pick up any buy orders on the other side. They work the spread against you. They work the spread against you to pick up the orders. Okay? Some typical stuff that we all know. When traders lose money, they usually take a day off to reevaluate their decisions, their life, their family, why the hell they got in this crazy business. I've read every freaking book. How come I can't make any money? Market makers know that this is happening. They know who they've called out. They know who's in trouble. They know how much money they made. They go into a chop, which I showed you on that previous chart. It looks like it's level 3. We call it level 3 behavior. That chop gives you a chance to come back, reparticipate in the market. The levels don't change. They hold it. They're chopping, chopping, chopping. What happens? You go ride around in your car in the middle of the night pissed off, go to lunch, pet your dog because you've been kicking them all week. So they got to hold the market and chop it around to get traders back into the fray. The cycle continues. The behavior starts over, and they suck you in again. Okay, something very important. The patterns are the same no matter what time frame you're looking at. A multi-session M or W will look a little different on a 1-hour chart or a 4-hour chart. The 4-hour chart might be railroad tracks because it's 8 hours, 2 sessions, right? 4 hours a candle in, 4 hours out. On a railroad track, you might get, on a 1-hour chart, you might get one railroad track on one side and a spike on the other side of the leg. But understand that the W or the M, when it's formed, it will be very aggressive. But once the work is done, you will get a straight aggressive move away from it. That's where you've been blinked your eyes and been down big in a trade. Our group goes into profit immediately and stays in profit. It's absolutely amazing when you catch it right. You're going to see. You grab second leg M or W right after they issue the second or third spike, you're going to go right into profit. Some people are asking about the charts. 15 minutes, unless I say otherwise. The 1 hour and 15 minutes are what we're going to talk about in here. Okay, look. 1, 2, 3 bars to the low, aggressive. Shifter consolidation zone. Okay? Breakout traders had a bad day. The shorts got rewarded. The longs got punished, shorts got rewarded. Okay? Aggressive 3-candle move, pins to the bottom. Notice how the pins spike to the bottom and pull it away? They're snatching the market away from the lower level short holders and jamming them. They then quickly pull away and come right back. In here, in the U.S. session, they throw 2 pins to the downside at the appropriate times. Session changeover, Brinks trade. That move fails to take out the London low. This move takes hours to develop. You now have your weekly reversal. It came in late Monday. That's okay. It happens. They're not going to make it Wednesday at 3 o'clock in the morning, perfect for you every time. You got to identify what's going on here. You have the first hit to the low, late Monday, London session. The second hit to the low, U.S. session, 9:30 changeover, session change, second spike. End the session with a false move down, first spike. Start the session with a false move down. Hammer, issued at 9:30, equities open. Your trade is entered right there. You can't pick a better entry than that. Stop loss is tight, right below the low of the day, which happens to be the low of the week. You've identified this behavior. You can keep your trade, hold for 3-level rise. 1, 2, 3. Reverse is imminent at the mayonnaise. Pin to the mayonnaise is a sell. You take the reversal here, end the day back in consolidation. Okay? I don't want you to take that reversal as a newbie. That is mostly a jam move because they've snatched the market away so quickly on the second leg to put all the traders that are short in deep trouble. That aggressive move does not always give you a nice retracement to counter. Okay, that's the DNC. Do not counter V1 and A1. I got slides, relax. Mayonnaise is a 200 EMA. Okay. We have our directional buys for the week. We have a mini W inside an aggressive W after the false move down. 3 vector candles to the low. Fake out the traders. Validate the short orders. Show a trend continuation. What happened in here was you sell the rises in a downtrend. So what happened is the traders that were long ended up with a scratch +1 when they came back. The traders that thought they were right and had their stops all aggregated in here are now stopped out on the second leg. Any pending orders that were trying to catch the break below the low were validated or turned hot on a widening of the spread at the lowest point on the chart. Second leg, intraday U.S. session, intra-U.S. session rather. This hammer, when that hammer pulls back, that was solid red at one time, right? That went down there all the way down to the low of the day, came right near the low and sat there. When you start watching this shit, it's crazy. The candle will go solid red all the way down there and sit there. And you're like, the hell's wrong with that candle? Did it die? Did my computer feed stop? It's just sitting there at the bottom. The candle sits at the low of the day. Some dealers will, you can see this, some dealers you cannot. But if you put the bid and ask line on your live chart, you will watch those two lines separate. The separation of those two lines or the widening of the spread lets you know I got these bastards today. Because they're punishing the retail traders with pending orders that are sitting below those price points and stop orders that are sitting below those price points. The widening the spread is part of the confirmation process. If they widen the spread a few pips near the low, on the second or third pass to the low, you got it today. You own it. Validation comes in when they complete the candle at the end of the 15-minute cycle and issue a hammer at 9:45. That is the confirmed locked reversal. Confirmed by their behaviors at the appropriate timings. You got it. You enter on the open of the next candle. Stop loss goes below the low candle or the low of the day. You look at the big board. I'll talk about stops and we'll look at the big board and stuff. They immediately shift the market or shift the zone away from the lower level short sellers and in one candle take back all of this damage. See this square right here? This candle seems to take all that back in about 15 to 30 minutes. You know when they shift the zone and snatch the market away from those guys, game on. You got it today. That is the confirmation you need to know you're in the right directional move. They'll shift the zone in one big candle, 15 to 30 pips. They'll shift the zone in two candles, 15, 20 pips apiece. But the shifting of the zone comes in a 25 to 50 pip move to get the hell out of there. They want to get the hell out of there to put all the retail traders into a panic. And it works. You lift your stop, you get nervous, you're like, oh crap, what did I do? The shifting of the zone creates the fear and greed that you're afraid of in trading. So when they shift the zone and jam you, you go into profit trading this method, you know you got it. That is further confirmation that you have caught the right directional bias off of the low of the day. Think about what you got. Okay? Consolidation, 41 pip channel. Blue box. Okay, I'll circle what I'm talking about. There's the width of the box. Initial high to initial low is 41 pips. Market makers come out. They show 1, 2, 3 to the low. You guys weren't falling for it. They came back 1, 2, 3 to the low one more time. Vector. A big anomaly on the chart. A spike. Retail trader perceived momentum. The vector is retail trader perceived momentum. You take that breakdown. They immediately put the brakes on and issue 2 pins to the low. It's kind of funny. The pins turn to the downside. I don't see any pins on the other candles coming down. But now the pins are on the downside. They pick up the orders and snatch it away. Pick up the orders and snatch it away. Now they got you if you're a retailer. They quickly pull back. That pullback towards the 50 validates the, what the hell is it? Rally-based drop, I don't know, drop-based rally or some crap that they teach in these other schools. I can't remember how it goes. But anyway, but it's a two-pronged approach. It also triggers the stops on the second pass down of anybody that was long and got it right. And it also lets those traders that end up at a +1 or a scratch, makes you scratch out with +1 or +3 or -5. There's a lot going on in that aggressive W formation. Understand? Same thing in the M. Again, they flip the pins to the downside to trap the traders at the lower levels. Because after all, the 50 and the 200 are wide open. So you got anticipated continuation down. But we know now that if the low that was formed during London holds, and they make 2 more passes at it, forming another W, and issue a hammer at 945, it's game over. You are a buyer against the retail trend, in line with the market maker. You own these bastards today. Further confirmation is seen on the shift of the zone off of the low to further trap the lower level short sellers and to take out the entire 6-8 hours of structure work all in here that they've done. That one candle destroys the entire structure that was built against the retail traders, trapping them all. The market is then into consolidation to create false sense of security for the downtrend continuation. It is again shifted away to trigger the stops, bounce off the 200 pins to the mayonnaise, and ends the day back in consolidation. Their business is done for the day. They did their damage. Okay? You guys good? Understand? Now, I have my bias. I know what to expect. The next night, I expect stop, hunt, low, rise. The next night, I expect stop, hunt, low, rise. They mess with you on the timings on this particular chart because they did the stop, hunt, low, and rise by the time you come to your terminal at London Open. It happened in Asia. You missed it. Not a big deal. But right at the end of the box, they threw railroad tracks to the low, and they even threw a hammer. There's a W in there, or there's a V bottom. You expect this, and they gave it to you. See it? Okay, they come out of the box, they go low. You are a buyer against the retail trader mentality long because you have your W formation. That's your anchor point for the week. W, V, V, M. Sorry about your luck. Do not counter. This is a counter here that worked. Do not counter here. I'm sorry, at V1. Do not counter at V1. It doesn't give you the trade. See the setup? It does not offer you the retracement to counter. It doesn't pay out. Now, notice how the pins flip to the top side. Notice how they flip to the downside over here. Notice how the aggressive moves end in pins to the top side. Railroad tracks at the U.S. session. This is level 3 behavior. Chop. 1, 2, 3 days of rise is seen. Disguised in different sessions, moved over a little bit to mess with your timing. Market makers give it out, give it out, give it out, need some back. Sell to the buyers, sell to the buyers, sell to the buyers. I need some of my money back, man. Correct the market. Okay, hope you guys are seeing this stuff. Okay, remember I mentioned in the thing, market makers will not move in one direction more than 3 days in a row without some type of collection of money. I know you say, Steve, the euro's been rising since my birthday, blah, whatever. I understand that. It didn't make a straight rise. Candles aren't stacked on top of each other straight up to heaven. They have to make pullbacks. Now remember the psychology element that's built in. The psychology element warrants that you will get on the trend at the worst possible time because of the 3 pushes inside the chart. They show you something, they get the whole world seeing it, technically, and then they act against it and mess with you. Notice the breakdown of this chart, okay? This is an entire week. Here's my Friday, Sunday, Monday tracers, right? Okay, let's look at it again now. Now with a different eye. Consolidation, false move week beginning, W formation, multi-session. I got a US session, leg 1. I got an early Asian session, leg 2. Right? Intraday, spread out over the day tracer, right? This is the day changeover. This is the 5 p.m. reset settlement, these lines. Okay? Friday, Thursday, Wednesday, Tuesday, coming out of Monday's consolidation. Midweek reversal. Aggressive move towards the low, validates the crossover down. The W formation, late US, early Asia. You missed it. But guess what? They offer you a pullback in the US. There's your peak formation low for the week. 3 levels of rise, end on an aggressive railroad track, pull back, consolidate into Thursday, repeat the level, but murder the stops and pick up the pendings with a monster pin above the first leg. The light blue tracer, is yesterday's high and yesterday's low. When market makers throw a hammer above the blue tracer, that's for all the Joe Ross followers that take the breakout of yesterday's high. They snatch those guys and reel them right back in. No offense to Joe, he's a great guy. That is our signal, notice it's in the red shadow box, to enter. Three days, 3 levels, they hit it, they pull back, they go into consolidation, they issue a hammer above yesterday's HOD, or above, which happens to be the high of the week. Notice how the two come in together? The high of the day on Thursday coincides with the high of the week. They repeat the level on Friday, trap the traders coming off of the U.S. session into consolidation in here. Then what do? The pattern continues going into the weekend. Bam! They hold it and they spike down going into the weekend. Someone said the sound is bad. Is it? Give me some Y's up there if everyone can hear me. No? Okay. It's not bad, or no, it is? Yes? No? All right. Fine. Okay. Okay. Thanks. Got it. All right. So now, notice the difference in this W, how it's tight. There's only a few hours in between. This one is a whole day in between. This is London Open, re-hit again, almost in the U.S. session, with a monster spike to the high. The monster spike to the high lets you know that they grabbed what they needed to grab. When you see that spike close, the damage is done to the retail traders. That spike is the aftermath or the wake of what they have done. What do they use to create the spike? Could be news, could be bullshit, could be your mother stubbed a toe. It doesn't matter. The behaviors are the same. they use the news to create that spike or create some type of anomaly on the chart to get you to fall for it. Listen, the retail side of the business works, or these guys wouldn't be so wealthy. Okay? Okay, so now you got trend is down, level 3 correction. You see this formation going into the U.S. session. They hold the level overnight. But you know the high was formed. They repeat the high. You're a seller against everybody else. You know that in level 3, the trend cannot go down forever and does not go down forever. You identify late in the U.S. session railroad tracks and then consolidation to end the day. You are a buyer against the retail trader's down move. And here's how it played out. This is what we call a half a Batman. They hit the stops one more time. If you weren't already in and you happen to be in front of your terminal, you're a buyer right there. I want to say 2 or 3 weeks ago, I think Rick's in here. There was a monster W formation in the Asian crosses. I missed it. I was eating at the Cheesecake Factory. That piece of cheesecake cost me thousands. It was double railroad tracks in the Asian session on GJ, EJ, and I think Rick just happened to be in front of the terminal and caught that 80 lots long. I don't know if that was okay to say, Rick, but sorry. And I think he booked a monster gain that day. So my cheesecake cost me, I don't even want to say the number out loud, it makes me sick. It was such an obvious trade that I promise you when you go back you'll see it. I want you to go back, write it down, go back to GJ and EJ, I want to say about 2 or 3 weeks ago. I think I was actually at the Columbia. I'm at the beach, so not now. I'm staying at the beach, but I think I missed that. I was at eating, I don't know, yellow rice and chicken or something. My gosh. Anyway, the moves are in there. Go back and try to identify that. Okay. I've been talking about their structures. Let's talk about the entire structure. Let me explain to you one more time. If you're sick of hearing it, I'm sorry. But this is, if I mentioned to you already, is the whole business. You got to get this. You got to understand. Okay? Every single day during initial market hours, Asian session, they're going to set the high and low. It's the initial high and low. They trade within that range and allow people to build positions, but not allowing anyone to take much of a profit. This is why you don't trade, Dave. Asia session. They then spread the swing. What time? 1 and 2 a.m. They widen the swing. That widening of the swing comes in before the London Open. Because the Asian market maker wants to validate the pending orders for the breakout traders. Okay? At the start of the European session, anybody? 3:30? They will severely correct or rise against their real intentions. Stop hunt, false move against what they're really going to do for the day. The drop or rise will trigger all the stops of the weaker traders, the ones that have taken the school, the regular technicals, read the books, the stop losses that go 5 to 7 pips below your entry candle or above your entry candle. The weaker retail traders that have fallen into some proverb that says if you're going to lose, don't lose a lot and make a really tight stop. It's bullshit. They then quickly go into consolidation. They don't have a chest cold. The market doesn't have the flu. They are accumulating contracts at another level. They will hit the stops one more time. As I showed you on the previous chart, they threw the spike above to trigger the stops and pick up the pendings on the other leg, the second leg. This action leaves the lower level or higher level traders stunned and stopped out. And then in one bar, they will shift the zone and trap all the retail traders at the lower or higher levels. And that's it. All right, I'm going to back up. Someone said they wanted to write the chart. Actually, a lot of people said, I'm sorry. Let me leave this up. I'll shut up for a minute, and then we'll go back to the other one, okay? I just realized that what I should do is, why don't you mark down the stuff you want and then go back and listen to the recording and get it? Wouldn't that be better than holding me up? Because everyone's at a different pace. People are writing. I think that is better, right? I always remember this about halfway through the first day. Yep, make a note that, hey, I want to see the section that was at 9:50 p.m. and then go back and move up to that timeline. Okay? Yeah. I think everyone's agreeing that I can just get through the slides and flow the recordings, and then you go back. Okay, sorry. All right. This is exactly what I'm talking about. You have the Asian range, right? R equals range, 51.4 pips. The ideal Asian range is 50 pips or less. The 50 pips or less allows you to see the stop hunts clearly. The stop hunts come in 25 to 50 pips below the box and above the box. Ah, now it makes sense what this is. Here's the 25 marker. Here's the 50 marker. The shadow box highlights the Brinks trade setups. Is it always going to fire in the Brinks trade box? No. But you have to have a deeper understanding of what's going on. Okay, so let's walk through this chart. You have consolidation, right? You have a pin to the low right here. Maybe they picked up some pendings. I don't know what happened here, but here's what goes on. Towards the